We'll call to order the Interim Joint Committee on Appropriations and Revenue, meeting number 4, Wednesday, September the 17th, 2025 at 1 p.m. Eastern Time, Annex Room 149. Welcome to everyone, and will you call the roll, please?
Senator Boswell.
Here.
Senator Funky Fromeyer. Senator Givens. Senator Maiden.
Here.
Senator Mays Bledsoe. Senator Neal. Senator Nunn.
Here.
Senator Rawlings.
Here.
Senator Richardson.
Here.
Senator Webb. Representative Banta.
Present.
Representative Bojanowski.
Here.
Representative Bowling.
Present.
Representative Bray.
Present.
Representative Bridges.
I got it.
Representative Brown.
Here.
Representative Dietz. Representative Fleming. Representative Freeland.
Present.
Representative Fugit.
Here.
Representative Gentry. Representative Hart.
Here.
Representative Lockett.
Here.
Representative McPherson.
Here.
Representative Riley. Representative Stevenson. Representative Thomas.
Present.
Representative Truitt. Representative Upchurch.
Here.
Representative Williams. Co-Chair McDaniel.
Here.
Chair Petrie.
Here. We have quorum, conduct what business we may need to, and the first will be approval of minutes. We'll entertain a motion. And I have a motion and a second for approval of the minutes. All in favor say aye.
Aye.
All opposed, nay. Minutes are approved, and I believe Representative Fugit may have an issue before we begin. Is that correct?
Yes, sir. Thank you, Mr. Chairman. I'd like to introduce two of my friends from the state of Iowa that's here today. If you two fellows will stand. Josh Kent in the maroon shirts, pastor of Victory and Grace Baptist Church. Willie Dobbs is a 27-year veteran police officer from town in Iowa. I just want to thank them for coming today. They came down to Men on the Mountain ATV ride, and they're hooked on Kentucky, so we're glad to have them today.
Very good. Thank y'all for being with us today. Any other members seeking recognition? If not, we will proceed to the first item on the revised agenda, number 3, major tax provisions in H.R. 1. That is not HB 1, that is not SB 1, that is H.R. 1, Public Law 119-21. I think we have Amy Sandlin and John Tennant, I believe. Come on up to the table, if you will, please. Have a seat. Pull the microphone close enough to you. When you're ready to speak, make sure that the green light is really green, bright green. And as we normally do, it's not because of the two of you, but as we normally do, if you will introduce yourselves for the record, please.
There you go. I am Amy Sandlin.
You want to make sure that microphone is really
Closer?
on and really good and close.
Oh boy. All right.
Very good. And then who else do we have with us at the table?
Good afternoon. My name is John Tennant. I'm a CPA from Lexington, and I want to thank you, Chairman Petrie and Co-Chair McDaniel, for having us here today.
Very good. Thank y'all for being here. If each of you will raise your right hands. Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I do.
I do.
Thank you very much. And if, again, we're on the topic of H.R. 1, and please proceed.
So as John already said, thank you for inviting the Kentucky Society of CPAs to present an overview of H.R. 1. We will refer to this legislation as OB3, or you'll see in the materials OBBB, so hopefully that has not caused too much confusion. And our presentation today will cover general information on the provisions we think are most relevant to Kentucky. So on our plan is we will discuss provisions affecting businesses, individuals, and nonprofits, and I'm going to start with 3 affecting the workforce. So the first one is one of the 3 provisions that are the no tax on provisions in OB3, so this is going to be your no tax on tips, overtime, and car loans. car loan interest. So all three are newly added sections in the Internal Revenue Code, and at a high level, they function similarly. So they are all individual, personal, federal income tax deductions for qualified amounts. Now, there are limits to the amount of the deduction, and the deduction phases out based on income. All three are also temporary provisions, so the deduction is only available for 2025 through 2028. So for qualified tips, the maximum deduction is $25,000. So for an individual that receives, for example, $10,000 in qualified tips during the year, their deduction is $10,000. If instead an individual received $30,000 in tips, their maximum deduction is $25,000. So the deduction phase out begins at income of $150,000 and ends at $400,000. For joint filers, the phase out range begins at $300,000 and ends at $550,000. So effectively, tips and overtime are taxed the same way they were pre-OB3 once income exceeds that phase out range. So going back to my first example of a $10,000 tip received by a taxpayer, let's say that taxpayer, when combined with the income of their spouse, they have $600,000 income for the year. Because their combined income exceeds the phase-out range, their tip deduction is zero. And for reference, the income figure that we are talking about here and will throughout the presentation is modified AGI, which is the calculation is specified in the legislation, but for most taxpayers, this is going to be adjusted gross income, or AGI. So next is no tax on overtime, and this works in a very similar manner. The really only distinction here is the maximum deduction. So the maximum for joint filers is $25,000, and for single filers, it's $12,500. So contrast with the tips deduction, which is $25,000 regardless of filing status. So if you had a single taxpayer that earned $25,000 in tips during a year, they would get a maximum deduction of $25,000. If instead that single taxpayer earned $25,000 of overtime, their deduction would be limited to $12,500. So the overarching policy change from OB3 is the creation of preferential tax treatment for two specific types of earned income. Those are your overtime and your tips. And the preferential treatment varies if a taxpayer is married or single. There are, of course, qualifications for income to be qualified tips and qualified overtime. So for tips, the requirements are the amount is paid in cash or charged. It must be paid voluntarily, and the amount must be determined solely by the payor. And the last one is it must be received in an occupation which regularly and customarily received tips on or before December 31st, 2024. Treasury is responsible for providing a list of those qualified occupations. They published a preliminary list at the end of August, and we expect the final list along with proposed regulations by the beginning of October. Overtime, what is qualified overtime, that is compensation that is required under Section 7 of the Fair Labor Standards Act. So the keyword here is required. And the deductible amount is the excess overtime payment that is required on top of the employee's regular income. So it's not the total compensation for overtime, it is just that required additional amount. And just to emphasize another point, both of these are, at this time, federal income tax deductions only. So there is no, OB3 did not make tips or overtime exempt from tax. So they continue to be subject to payroll taxes, so employer, employee, and at this time, state and local taxes. Next is a new type of tax-favored savings account. And these are
I do want to check on those first two that you talked about, effective range. We have both of those ending with calendar 28. Is that correct?
correct.
And would die an organic natural death on that date unless someone resuscitates with extraordinary artificial measures. Is that correct?
I believe that is the correct interpretation.
Very good. Thank you. Just making sure.
Thank you. So next is, like I said, the tax-favored account. These are the Trump accounts, and if you are familiar with IRA accounts, there are some similarities here. So the Trump accounts are created for children under 18, and they are funded by contributions up to $5,000 a year, and distributions cannot be taken from that account while the child is under 18. There is also the pilot program, which is the federal government will fund $1,000 to contribute Trump accounts created for children born between 2025 and 2028. And we've included this in the workforce section because there is an employer plan option. So employers can create a Trump account plan and contribute up to $2,500 to an employee or an employee's dependent Trump account, and that contribution is excluded from the employee's income.
Okay, we will now briefly cover some of the...
Before we go on to that, Senator Boswell, do you have a question about one of those first three?
Yes, sir, Mr. Chairman, if I might.
Please.
Yes, just a question about the overtime. So in overtime, you have, let's say you work 60 hours, so you have 20 hours overtime. Is it my understanding now that the only amount that's deductible is the overtime portion, so the regular 20 hours of that would still be taxed? It's just the overtime portion. So there's a lot of misunderstanding about that.
Yes, Senator. So it is not the entire amount paid for that additional. It is just that bump up in pay rate.
Very good. I'm sorry. If you will, please proceed.
Thank you. We'll now cover some of the business provisions of the One Big Beautiful Bill Act, starting with the depreciation of business assets. Accelerated depreciation is one area in which Kentucky has historically decoupled from federal tax law, even when general conformity bills have been passed. However, we thought it was important to touch on these provisions as they are some of the most important for taxpayers. First, bonus depreciation is a mechanism for deducting a larger portion of a fixed asset's cost than the standard depreciation tables would allow in the first year that asset's placed in service. It applies to most assets with lives of 20 years or less. With the One Big Beautiful Bill Act, bonus depreciation is back at 100% for assets placed in service after January 19th, 2025, and this time it's been made permanent. Prior to the passage of the bill, we were at 40% bonus depreciation for 2025 and scheduled to reduce further to 20% in 2026. In addition to this, the One Big Beautiful Bill Act adds a new Code Section 168N, which essentially allows the taxpayer to take bonus depreciation on certain commercial buildings, which are normally not eligible due to being 39-year property. These buildings are new domestic qualified production property plants that engage in manufacturing, production, or refining of tangible products. The idea is to encourage investment in manufacturing by providing a cost deduction for the plant immediately instead of over 39 years. Unlike bonus depreciation that we just discussed, this provision is not permanent. Construction on the plant must begin between January 19th of 2025 and January 1st of 2029, and the building itself must be placed in service before January 1st of 2031. Finally, there have also been some updates to Section 179 expensing, which is a long-standing provision of the tax code that Kentucky has also historically incorporated, albeit with lower limits than federal. Section 179 is an optional election that also accelerates depreciation on certain property, although it has various limits and cannot be used to generate a business loss like bonus depreciation can. Under the One Big Beautiful Bill Act, taxpayers can take a federal deduction of up to $2.5 million on certain new assets as long as their total investment in assets for the year does not exceed $4 million.
Very good. We're going to take real quick. Senator Gibbons, did you have a question on one of the first three or on that most recent one?
I did, Mr. Chairman.
Please proceed.
Thank you. Back to the first three that you presented on, I'm thinking about my W-2 that I provide my employees at the end of the year. That W-2 is going to have to change help me to understand what box is this going to be in, and how do I do this?
Yes. So, Senator, thank you for that question. That's a great question. So the W-2 is going to have to change. So will if you have a 1099 recipient. The IRS announced, I think it was at the end of August or early August, that they are not changing the W-2s or the 1099s for 2025. And they have also stated, in rather vague, they will provide taxpayers who take the deduction relief. Because in the legislation, it does specify your deduction is the amount that's reported on one of these forms. And so the expectation is there's going to be a lot in 2025 that are not reported because employers do not have time to update their operation, their payroll reporting. We have advised our clients at this time, if it's possible, to use what is Box 14, which is other amounts that are not specified elsewhere on the W-2. If you can capture that amount and report it to provide certainty to your employees, you should do that. For 2026, the W-2s, 1099s, it's certain they will change. The draft W-2 has also been published, and on that one there is now Box 14 has been split into Box 14A, 14B, and one of the boxes, I think it is 14A, is still the other unstated items, and then 14B is specific for the occupation, and this is for employees that receive tips because you need to verify that this is an eligible occupation. And then Box 12, there's two codes added to Box 12 where the actual amounts will be reported in 2026. And then the other update that has been published, I think this was in the last week, the W-4 that employees would have to fill out that will be updated.
Thank you.
Thank you. Please proceed.
So moving to R&D expensing. Under previous law from 2022 to 2024, R&D expenses had to be capitalized and amortized over time instead of deducted immediately. This did create a pain point for many of our clients who engaged in research, as they would generally end up with taxable income, but often limited cash in the bank with which to pay the tax bill. Under the One Big Beautiful Bill Act, domestic R&D can now be expensed again, beginning in 2025. However, taxpayers can also accelerate the amortization of previously capitalized R&D expenses to take those unused deductions over the next year or two. Small taxpayers, which are under $31 million or $30 million of gross revenue, can also optionally go back and amend those prior year returns to take the expense immediately. Gambling provisions are also often of interest in Kentucky. Under previous law, wagering losses could be deducted up to the amount of wagering gains. Under the One Big Beautiful Bill Act, however, beginning in 2026, gamblers can only deduct 90% of wagering losses while still maintaining the provision that they cannot exceed wagering gains. Most notably, this applies to both casual gamblers who itemize their deductions, as well as professional gamblers who take their losses and other business expenses as business expenses. To illustrate, let's say a professional gambler has $300,000 in wins and $240,000 in losses and other expenses in 2026. The taxpayer is probably expecting to report income of $60,000, but since the $240,000 of losses and expenses are limited to 90%, he or she can only deduct $216,000 of expenses, generating $24,000 of phantom taxable income. I will now turn it back over to Amy for a discussion of some individual provisions in the new tax bill.
So we're going to cover a few of the major individual provisions.
I'm going to interrupt real quickly just to follow back up on those that you just mentioned relative to business. I was chastised by my co-chair not to talk in terms of organic death and use sunset instead. So those provisions regarding business, I saw no sunset dates on that, correct?
Correct.
All right, just making sure. Thank you.
Yeah, so just to add a little context for, I'd say about half of the ones you talked about, those, if you're familiar with the Tax Cuts and Jobs Act of 2017 and the business provisions, some of them were temporary, so a lot of the OB3 changes here for businesses on when we're talking about provisions that have existed, maybe slightly modified, they are generally made permanent. All right, next up, so the individuals, and I'm going to start with the state and local tax deduction and also start with an apology to any of you who are hoping to never have to think about pass-through entity tax elections again. So unfortunately,
Moving
pass-through...
on to item number 2 on the agenda. No.
Thank you. So yes, thank you. That's great. So OB3 did raise the limitation on the individual itemized deduction from $10,000 to $40,000. There is a income-based phase-out of that $40,000 deduction, and the phase-out starts at AGI of $500,000, and then the phase-out range ends at $600,000. So once you hit the $600,000 top of the range, you are limited down to $10,000 tax deduction. The $40,000 limit and those phase-out ranges are scheduled to increase for 2026 through 2029. And then after 2029, they will revert to the 10,000 cap that we have been familiar with the last few years, and that is indefinite. They are not going to sunset or die a natural death. Is it okay that I am an accountant and I said that? Is that allowed? All right. So the higher limit from 2025 through 2029 does mean some taxpayers will forego the pass-through entity tax election, but many, especially your high-income taxpayers, will continue to make the election. There's two real reasons for this, and the first one is probably obvious, the $40,000 limit. If their taxes, and this is all their taxes, income tax, property tax, real estate, if they're over that $40,000 limit, the pass-through entity tax election does give, they still benefit from the quote-unquote unlimited deduction. And then the second reason is a combination of both the phase-out range, that threshold, plus another new OB3 provision that is going to limit overall itemized deductions for taxpayers in the highest federal tax bracket. So this limit is in addition to your $40,000 cap. You take all your itemized deductions, and then it gets limited again. So pass-through entity taxes are not subject to that limitation, the $40,000 phase-out, which is why we'll continue to see taxpayers making that election. Next is the third and final no tax on provision. This is no tax on car loan interest. It is a $10,000 deduction annually, and it phases out for income starting at $100,000. It's fully phased out at $150,000. For your joint filers, the phase out starts at $200,000, and it phases fully out at $250,000. Now, your general qualifications for this deduction. First is it must be a newly acquired vehicle and the debt incurred after December 31st, 2024. The vehicle must weigh less than 14,000 pounds, and final assembly must be in the U.S. Last in the individual section is another temporary deduction. This is an additional $6,000 deduction for seniors age 65 and older. The deduction will phase out for income starting at $75,000 and ends at $175,000. For your joint filers, that range is $150,000 to $250,000.
And Amy, if I could comment on this one, this has been promoted in the media often as a no tax on Social Security provision. That is not exactly what's going on here. This is available to seniors based on age, regardless of Social Security.
Do you want any questions before we move on to nonprofits? All right. So there are a number of nonprofit provisions. We are going to focus on charitable contributions today. The first is a partial deduction for non-itemizers. This is something we saw in 2020 and 2021. OB3 made this provision permanent, and it raised the amount to $1,000 or $2,000 for joint filers. Also, are now floors to the deduction for individuals and corporations. And how this will work is for individual taxpayers, their charitable deduction will have a 0.5% haircut, and corporations will have a 1% haircut.
Okay, and finally, we're going to talk about a new provision of the tax bill that covers SGOs, or scholarship granting organizations. These must be separately established under state law, but it's a federal tax credit. These SGOs are nonprofits that provide scholarships for K through 12 education and expenses. However, when a taxpayer donates to one of these SGOs, instead of getting a normal charitable itemized deduction, they get a dollar-for-dollar tax credit up to $1,700 per donor, or that could be for twice for married filing jointly. The idea is to encourage donations to these SGOs and expand educational opportunities for K through 12 kids who are at or below 300% of the area median gross income. That's our last slide in this general presentation, and we're happy to take some questions on these or any other provisions of the One Big Beautiful Bill Act if time allows.
I think thank you very much for the presentations. Up first, Co-Chair McDaniel, question, comment?
Thank you, Mr. Chairman. Guys, would you go back to 2 slides, please, to the charitable? There you go. Could you explain the deduction ceiling and floor, please?
Yes. So the way that will work is if you start the individual, so your contribution, your amount of your contributions for a year, you have to hit 0.5% of your AGI or your income for that year before you can take a deduction. So if your contributions are under that calculated amount, you don't get a deduction. And then once you exceed that amount, you get a deduction, but you still lose that 0.5%. And the same is going to be with corporations, except for it's 1%. And also corporations had, this is not new, continue to have, there is also a 10% ceiling on theirs, which is if your contributions exceed 10% of the corporation's taxable income, you cannot deduct the amount over that 10% and you carry it forward. So that is unchanged.
That's organizational, but does the 10% ceiling apply individually as well?
No, just corporations.
All right, thanks. Thank you, Mr.
Representative McPherson?
Yes, on your slide about your contributions for give scholarships, does churches fall in that anywhere?
The new SGOs, or scholarship granting organizations, will be organized as 501c3s, but they are a special kind of nonprofit that must be established under state law, and it's possible that some states will not actually establish these. So it's not clear how widespread this will be at this point. However, churches would not, by default, qualify. It would have to be specifically an SGO that's established.
Thank you.
Yes.
I'm waiting for the geese to fly over. Senator Givens.
Mr. Chairman, thank you. And it almost felt like I was back in one of my college tax classes. This has been a great presentation. My question is on the SGO slide. So this is going to be for tax years 2027 and on, correct?
Correct.
So 2027 and beyond. Now, correct me if my statement is inaccurate. Once the state sets up this process or mechanism, the taxpayer is then given the opportunity to either send $1,700 of federal tax owed to Washington, D.C., or to spend and send the $1,700 to an education SGO within Kentucky.
That's the net effect. The donation would be made directly to the SGO, and they would receive a federal tax credit. So the taxpayer would get that $1,700 back, assuming that they had a tax liability. This is a non-refundable credit, meaning you have to owe some tax to get it back. But the unused portion could be carried forward up to 5 years. If you did owe tax, then you would receive that federal tax credit back, so you'd get your $1,700 reimbursed back to you, but you would have sent the money, like any other charitable donation, directly to the SGO.
I want all the members to understand what has just been said. You've got a choice in 2027 and beyond to either send your $1,700 to Washington, D.C. to go for whoever knows what, or to spend it on education in Kentucky. Let's all be supportive of that happening and staying in Kentucky. Thank you.
I'm sorry, Senator Givens. There was I had an echo of geese. I couldn't hear you. What did you say in conclusion there? And if you'll speak slowly so I can catch all of that.
I appreciate the chance to emphasize it, because this is a stump that I want all of us to be on. I'm sincere in saying I don't think there's a downside to this. If there's a downside to it, I need to understand it. I can choose to send $1,700 to Washington, D.C. and let them do with it whatever Washington, D.C. does with it, or I can send the $1,700 to a scholarship granting organization within Kentucky once we've set up the mechanism and structure. I would hope that we would keep the money in Kentucky to benefit Kentucky kids. If the geese fly again, I'll say it again.
I think.
One thing to note in there, in the requirements, not disputing anything you're saying, but just to add some additional information there is, so these SGOs are a special type of organization, and within the legislation there are, I would say, oversight and reporting requirements on these entities. So that is just something to keep in mind, that there will be an administrative burden, and that is, an oversight need at the state level if these are used.
Very good, thank you. Representative Lockett.
Thank you, Mr. Chairman. I just want to echo and actually ask a question on the SGOs. This is actually one of the provisions of the One Big Beautiful Bill that I was very excited about when it came out for a lot of reasons. And my question is, in terms of the state opting in and establishing these SGOs, what kind of guidance is there? What kind of parameters are there? And approximately how long would it take us to do that?
I believe this is one of the reasons why they've pushed this out a couple years. So unlike some other provisions of the bill, which are effective immediately or starting in 2026, this is effective for tax years ending after December 31st, basically in 2027. So we are waiting for guidance on this, and that's something that will be promulgated, but I don't have a clear answer for you right now.
Okay. Thank you.
Thank you, Representative.
Thank you, and I'll just point out for interest, Representative Lockett and Senator Givens, I believe there was educational opportunity account bill that came through this committee that went through the General Assembly a few years ago that oddly has some similar structures to what this SGO is defined as. And although I can't say whether I have looked at it recently, but I don't think it will take a lot of effort to modify its structure. So, as just a point of interest, point of reference, if they want to look. Senator Gibbons?
Mr. Chairman, if I could reflect back briefly on what you've said, you're exactly right. At the same time, my limited understanding is that these SGOs can be used for public or private educational opportunities, so it doesn't have to be one or the other. It can be both and. So,
and if you'll recall, the educational opportunity accounts that did pass through were for private and for public.
That's
use.
correct. That's correct. Sometimes we get lost in the minutia of one side or the other, but let's all try to be supportive of this to the degree we can. Thank you.
Thank you. Any other members seeking recognition for question or comment? Anybody else need to check in? All right. Seeing none, thank you very much for the presentation. Not the easiest stuff in the world. Did a great job with it. Appreciate the detail. It was put together well, and only could KYCPA pull that off, I think. Thank y'all very much.
Thank you very much.
Thank you.
Next up, we have on the agenda item number 4, Kentucky's workforce and all things therein. And I believe we have with us Kate Shanks of the Kentucky Chamber of Commerce and Charles All of the Kentucky Chamber of Commerce. And even though I still said that, if you will introduce yourselves for the record, make sure your microphones are close to you and they're really green and turned on nicely before you start speaking.
Good afternoon, Kate Shanks, Senior Vice President, Public Affairs, Kentucky Chamber.
Charles All, Vice President of Policy, Kentucky Chamber.
And then just to make sure we're all on equal good footing, if you'll raise your right hands, do you swear or affirm to tell the truth?
I do.
I do.
Thank you very much, and please proceed.
Thank you, Chairman, members of the committee. Thank you for the opportunity to speak this afternoon on a couple of issues that is really important to us that we'll be focusing on for the upcoming legislative session, and that is childcare and housing, and how our workforce challenges, which Charles is going to talk quite a bit about, are impacted by childcare and housing. And this is a topic that, we have been before committees numerous times over the years talking about our workforce challenges in Kentucky. It's a stubborn problem. There are demographic changes that are impacting it for sure. And we greatly, greatly appreciate the work the General Assembly has done over the years to tackle policies, pass legislation to address some of our workforce challenges. And we look to the 2026 session to do more work on child care as well as on housing, because we think those are two important issues that relate to this particular problem. We are not going to present today some big new government programs.
Sorry, what did you say again?
We are not going to present today some big new government programs. We are going to be very strategic and tactical with what we're going to be talking about and the recommendations that we're focusing on, because we think that's the appropriate approach for tackling these issues. So the way this is going to work, Charles is going to give you a lay of the land on the latest on all things workforce. And he's going to talk about these issues within the context of workforce. And then I'm going to talk about some examples of the policy recommendations we're going to be working on and championing for the upcoming session. So with that, I will turn it over to Charles.
Thank you, Kate. Thank you, Chairman, members of this committee. We greatly appreciate the opportunity to talk through this issue. I know members of the General Assembly and this committee in particular are very familiar with the nature of Kentucky's workforce challenges, so I'm not going to belabor the point too long, but I do want to make sure you understand the perspective that we are bringing to this conversation and how we view Kentucky's workforce challenges. So I'm going to just really cover a few slides on this issue to hit what we think are some of the most important points about where we are with workforce issues in the Commonwealth. What you see on the chart in front of you, or what you see on the slide in front of you, is a chart that outlines Kentucky and United States workforce participation rates for our 16-plus population since the year 2000. So we're going back to the very start of the 21st century. The blue line is the United States. That red line is Kentucky. And you can see a pretty clear trend line. Ever since we entered into the 21st century, we have seen a consistent decline in the share of our adult population that is actively participating in the workforce. And when I say actively participating in the workforce, what I mean by that is that this is the share of the population that is employed or is unemployed. And unemployed in this context means they don't have a job, but they're actively looking for a job. If you don't meet either of those two requirements, you exist outside of the labor force. And so again, you see this big trend line here with rates decreasing at a pretty steady pace. There's some bumps along the roads, but overall that trend line is pointing downwards. Demography and demographic change is really the key driver of this. Now, there's a multitude of factors that are going to be contributing to suppressed rates of workforce participation, but demographic change is your number one issue. And what's going on there is our population's getting older. As the baby boomer generation is entering into that retirement phase, we've had less children over the past few generations. And so a consequence of that is we're kind of backloading our population, where we're having more and more of our population that's getting older. And as those folks enter into that 60 plus category, they're now retiring. And at the same time, we're not backfilling at the rates that we used to.
So I want to make sure on this chart, the workforce participation that you're trying to depict is from 18 to infinity?
This is our 16 plus. So this is going to include your elderly as well.
Okay.
And so that's that's a really important thing to understand about this.
Because a lot of the times, as you know, and I just want to make sure everybody's clear, when we talk about workforce participation, lots of times we'll talk about 23 to 54-year-olds.
Correct.
Prime working age by definition. So
Absolutely.
This is 16 and on.
Yep, this is sort of your standard workforce participation. We'll look at prime age here in just a minute. One of the things I also want to highlight with this chart here, though, is that this is a trend we expect to continue for the foreseeable future. The Bureau of Labor Statistics produces projections for workforce participation rates, usually about 10 years into the future. So we took that blue line and just followed Kentucky's general gap between Kentucky and the United States and extended that out to about 2034. And so we anticipate a continually smaller share of our adult population participating in the workforce. As the chairman pointed out, it's very important to talk about what we call prime age workers. Anytime you're talking about workforce participation, prime age workers are this population is generally 25 to 54-year-olds. Sometimes we call this the working age population. We can use prime age because these are those prime working years. This is a very important part of our labor market. Right now, it's around 63, 64% of our labor market are these workers. But one of the things that's important to understand about prime age workers in Kentucky is we have a lot of challenges in this space too. It is true, our prime age workforce participation rate is considerably higher than our overall workforce participation rate. So here you're looking at about 80.6% versus going back to your overall workforce participation rate around 58%. give or take. But one of the things I want to point out here is that with prime age workforce participation, we're about 3 percentage points lower than the national average, and we rank about 45th. So the story is not all that different here. One of the things I do want to point out, and I don't have this up on the screen, that prime age population is getting smaller. So if you go back to around the year 2000, that age group made up about 70% of our total labor market. Now it's down to closer to 63, 64%. That's another trend you can expect to see more of, as that working age population represents a smaller and smaller share of our labor market. Very important to point out, there's a significant amount of regional variation in workforce participation rates in Kentucky. I don't want to get too far into the weeds here, but one thing I want to note, I'm using a different survey with these two graphs than what I used previously. So I was previously using Bureau of Labor Statistics, which is the current population survey. Now we're looking at the American Community Survey, and I just want to bring that up because you need to be cautious about comparing these two things. But what you're looking at the top is ages 16 plus, or overall workforce participation. Ages 25 to 54 at the bottom are prime age workers. And you can see a tremendous amount of regional variation. So within our 16 plus age group, we've got 34 counties that are at or below 50%. 24 counties have rates above 60%. We have counties such as where Chairman McDaniel is from that tend to have significantly higher rates of workforce participation than the rest of the state. On that map, you can also see a heavy concentration of lower workforce participation rates in the eastern part of the state. If you look at our prime age workers, here again, there's a lot of regional variation. I think one of the things that's most apparent is the urban-rural divide. When it comes to prime age workforce participation rates, you really see that very clearly. One thing I want to stress is I do caution trying to make too many conclusions when you're looking at these regional variations. Every state that you're going to look at in the country is going to have a lot of regional variation in workforce participation rates. So one of the things that it's important to ask is, how unique is this regional variation? How unique are the disparities between urban and rural areas? And then also, how are these counties performing relative to expectations given their demographic makeups? So there's a lot of big questions there, and this is something that we're continuing to explore over time, but I did want to highlight there's a really important regional story. In terms of addressing these challenges, and I think we're at the point where everyone generally agrees these are challenges that are going to get worse over time. These will create significant barriers, especially if you think about our tax bases, the dependency ratio, so comparing the number of people that are producing goods and services versus the number of people that are dependent on goods and services. This is going to be a big part of our story for at least the next 20 years or more. In terms of solving this, the Chamber has been talking about a host of solutions really ever since about 2021, when we produced a big report that I have here on the screen called 20 Years in the Making, Kentucky's Workforce Crisis. And we've really recommended a 4-part strategy: attract more working age adults, optimize current workforce programs, support opportunities in economically depressed areas, which can help increase workforce participation if we have more job availability in those areas. And then, of course, remove barriers to entry for Kentuckians who want to work. So thinking about folks who want to work, what are those barriers that they're in front of? The good news here is this General Assembly has done a really phenomenal job getting out in front of these issues. Think about things like trying to structure good tax policy to make sure we have an attractive state for workers. Thinking about things like ensuring the alignment and effectiveness of our workforce development programs, investing in education. I think one of the things that's very important for all of us to remember is that the returns on those investments will take a very long time. That's the game we're in right now, is that these things will take a long time to see the results of this. But it's important to stress that we're doing a lot of the things right. There are 2 particular areas that we're going to be talking about in more detail here today, where we do think we could push a little harder to get a little bit more movement and continue applying that upward pressure as we continue to face declining rates of workforce participation. First of those issues is access to childcare. And I want to be clear, when we talk about access to childcare, what we're talking about are about 2,000 or so small businesses, nonprofits, and faith-based organizations that are providing regulated childcare services around the state, primarily for parents who are participating in the workforce and parents who choose to utilize those services. Connections between childcare and workforce challenges is not a novel concept. This is something that's been studied for several decades now. There's a body of academic literature that talks about this thing. However, it's really difficult to put together estimates of the actual impact of what happens if you increase access to childcare in terms of the labor market effects. And the reason for that is we know that some parents, emphasize some parents, may need access to childcare in order to work or look for work. But it's important to note that these parents likely faced a myriad of different other barriers. And so if you simply just provide childcare, that will probably help with some families. They'll automatically be able to enter the labor market, but there's a lot of others that are going to face a whole host of different issues. What's important to understand, it's part of the puzzle. And that's a big thing that we need to understand as we're trying to remove these barriers to work. This is going to be part of the puzzle. We did try to create some estimates around this for Kentucky, and that's the subject of a new report that we released last month. I have that report up here on the screen. And what we did is we partnered with some economists at the University of Kentucky, specifically Allison Davis. Some of you might be familiar with her excellent work at Blueprint Kentucky, where we tried to model out what are some realistic expectations for parents that could be potentially influenced to join the labor market, have the ability to join the labor market in the event that childcare was more available and more affordable. And so I want to talk through that a little bit. What you have on the screen are estimates of non-working parents in Kentucky who might reasonably be able to join or rejoin the workforce if childcare were more available and more affordable. And I want to be really clear on something here. We're not saying that if you make childcare more available and more affordable, that you're automatically going to get this influx of new workers. Instead, these are the workers that we think are essentially potentially able to join the labor market if these things happen, but considering other variables that play at the same time. That's a really important point to keep in mind as we talk through this. What we estimated is a spread here ranging at the high end of about 16,000 to around 28,000 workers if you could reduce pricing by about $500 a month and assume that childcare is available for any parent that wants it. And then you can see how that scales down based on other monthly price reductions. I want to comment very quickly on the methodology because this is a very tricky thing to do, and I want to make sure you guys are understanding how we approach this. The first thing we did is that we created an estimate of the number of non-working parents of children below the age of 18 throughout the state. From there, we created two panels, one based on survey evidence, another one based on academic literature. And that academic literature goes back to the 1990s. And that's why we had two different estimates. We wanted to have something that was very high quality in using historical academic literature, and then another panel that used more recent survey data. That academic literature is the one that led us to estimates around that 16,000 range at the high end. Survey evidence is what led us to those higher end estimates. And there's pros and cons to utilizing both of those. But that allowed us to create a universe of parents for whom this would be a factor in their decision to join or rejoin the labor market. From there, we created a rate of entry based on monthly price reductions to average childcare cost. And so that's how you end up with these estimates. But one thing I want to continue to be clear on is that this isn't some sort of magic bullet. There will be other barriers that those parents would face as they increase their ability to participate in the labor market due to more childcare access and due to more affordability. I want to switch over to housing and talk through this issue for a few minutes.
Before we go over to the housing,
yes, sir.
Representative Fugit, do you have a question or comment?
Yes, sir. Thank you, Mr. Chairman. If you go back to the regional variation in workforce participation, you made the statement that Eastern Kentucky was the lowest participation rate. Is that right?
It has the highest concentration of lower participation rate counties.
Okay. Can you tell me what year it began to the workforce participation rate began to increase, or the lack of participation? You have those stats?
That's absolutely attainable, Representative Fugit. But in terms of, are you asking when the decline really started?
Right, yes.
Generally speaking, I don't want to answer that on a regional basis without looking in more detail. The broader story is that we tended, 2000 is really kind of when we sort of entered into that demographic moment. Now with Eastern Kentucky, you might end up with more significant reductions at specific times in alignment with things like collapse of the coal industry or challenges within coal industries. I mean, those types of impacts to employment sectors, that's having an impact in these spaces, absolutely.
So you call it the collapse of the coal industry. I call it Obama's war on coal is the reason why. But I'd like to have those numbers, specifically the years that the coal industry was put out of business by federal regulation. I'd like to have those stats just for personal knowledge, if you could get those to me.
Well, what I'm going to ask is, rather than for personal knowledge, we'll put it in as a public side. And if you can get that back to the committee And if you need any back and forth, Representative Fugit or myself, either one will make sure that we're asking for the appropriate thing and make sure we're not churning too much work to get what we're after. Okay? Would you mind doing that?
Yes, sir.
And then we'll make sure everybody's got it. Okay?
Thank you, Mr. Chairman.
Thank you.
Happy to do that.
Senator Funky Fromeyer.
Yes, this is the same slide that I was interested in. Thank you, Mr. Chairman. So last legislative session was only my third. So there was a lot of discussion around the age that children could work. And when you noted 16 plus age group, there are 34 counties that have rates at or below 50%. So I'm thinking to your point that since the turn of the century, we've seen this steady decline. I'm also remembering, as a mother of 6, that I've got these kids that are playing sports at about 15 to 20 to 30 hours a week, yet they can't be employed. So what's happening here? And I don't actually know and would love to better understand how has Kentucky's laws changed since 2000 to the present, perhaps restricting young people to work sooner or hours that they're interested in working?
That's a question I think would certainly just require us to do more research to understand changes to labor regulations in that particular space, but I can't answer that off the top of my head.
And candidly, I'm eager for your thoughts, and as you put together recommendations for us to consider, I was alarmed by the friction we received last legislative session. But I will tell you, in my visiting of my Senate area that includes some rural areas, there's a real interest in young people that have a desire to work more than they're allowed to. I'm a bit alarmed by that sure. We're restricting young people's freedom, especially when their parents are interested in that opportunity for them. So would love to better understand that.
Yeah, and Senator, as a teenage boy mom, I hear you. My son's been working since he was 14. And I had to drive him back and forth to his job, 30-minute drive each way. So House Bill 15 that changed some of the rules around driver's licensing didn't affect him, but my next son will be affected by that. And so I think you all have tackled some of this to a point. But, this one strikes me specifically because I love for my kids to work, get out and make money.
And I'll say the same thing as a father of 3 that are, the youngest is now 19. Trying to instill a work ethic and learn from that. Really, you can't find anybody that'll hire below the 16 mark unless it's a really personal industry as opposed to a commercial industry. And at 16, then you end up with the driving situation. Parents can't, and so the House Bill 15 last year should help with that. Yes, we want them to. If there's any barrier to it, I'd like to know. But for 16 and above, mine all stayed employed, so I don't know if there was any problem at that point. All right, Senator Nunn.
Thank you, Mr. Chairman. Thank you both for being here in this report. It's a topic I'm keenly interested in. The labor market tends to ebb and flow. Unfortunately, it seems to ebb more than it flows. If you look at the first slide that you had that compares Kentucky's labor participation rate to the national average, we started catching up, closing the gap around 2010, and it had narrowed. And then, like I said, they kind of, Kentucky's rate goes along with the national rate, except in around 2013, 2014, we had a very precipitous drop that we didn't see at the national average, and we haven't quite made up that ground. Do you happen to know what happened around that time or have any theories of why we saw that significant drop?
It's a great question, Senator. Thank you for that. It's a difficult thing to pin down. One possible explanation for this is a little bit of a delayed impact from the Great Recession, where we had a lot of workers who probably continued to qualify as unemployed workers during this time, and therefore they would continue to be showing up in our labor force. And over time, as job availability continued to be very scarce, they eventually stopped looking for work and fell out of the labor market. And so there seems to have been a little bit of delayed activity from the Great Recession that might be influencing that. But without further research, it's a little bit difficult to tell exactly. And you can see the recovery from that period is a little bit more severe than what you see at the national level too. So the bounce back at the same time is also something that deviates. And this is fairly common when you look at state workforce participation rates. They do deviate from the national average in various ways due to idiosyncratic things happening within those states.
Follow up, Mr. Chairman. In any state policy that changed around that time that maybe would explain that drop? Anybody here on the committee that might remember that, or around 2013, 2014? If not, just curious.
No state policy,
Okay.
General Assembly, that I can recall. Somebody else might. I mean, what you've got is you do have a major shift in federal policy regarding Medicaid and the expansion,
Yeah.
the ACA expansion at that point in time, but nothing else that I can think of.
All right. Thank you.
All right, so I just want to clear those off the deck. Please proceed.
Thank you, Chairman. I'm going to shift over to housing for just a couple of minutes, and then Kate will move into our more proactive discussion around potential policy solutions for 2026. The Chamber started studying the housing issue in more detail really last year. We were kind of new to this conversation, and the reason we got so interested in it is because it was something we were hearing about from our members, and we published a report in partnership with the Home Builders Association of Kentucky in June 2024 called Building a Foundation for Growth. And this is a big, long report where we talk about the housing issue from a number of different perspectives. But I can really try to summarize it succinctly by pointing out that the core problem that we looked at in this report with housing is really a supply issue. And the chart that I have up here is a quick illustration of what we're talking about when we discuss supply constraints in the context of housing. This chart shows building permits issued in Kentucky for single-family and multifamily units going back to 1995 on an annualized basis. And what you can see is leading up into the Great Recession, Kentucky was generally producing somewhere in the range of about 19,000 to 20,000 new units per year. Coming out of the Great Recession, there was a precipitous drop in the actual building of new single-family and multifamily units, and particularly in the heights of the Great Recession and into that recovery, really just built up a significant deficit during that time. At the same time that we're building up that deficit and not building at rates that we used to, population is continuing to grow. And so consequently, you end up with significant supply challenges in various parts of the state. And that's one of the reasons we think that you hear so much about a housing shortage. And there's all sorts of different estimates of what that shortage looks like. But this is, in a lot of ways, the story behind that, using building permits as a proxy for building activity. One of the consequences of that is when you have an imbalance between demand for housing and then the supply of housing as things just get more expensive. Now, to be clear, that's not the only thing driving up housing costs. There's other factors such as inflation, high interest rates, all those different types of variables. But when you have a lot of people looking for homes and not as many homes as you used to, you're going to end up with higher priced homes. And you can actually see this on the chart that I have on the screen. So what we're looking at here are comparisons between median home sale prices to median household incomes. And so this is a way that we can account for changes in household incomes and inflation and those types of things. And we compare that to 1994 all the way up to 2024. And so if you take a community like Bowling Green, for example, you can see back in 1994, your median home sale price was about 3 times median household income. Fast forward to 2024, it's now about 4.5 times median household income. And so when you hear folks talk about the difficulty of affording a new home, they're not kidding. It really is more expensive in comparison to actual household incomes. And one of the reasons that this is so important, not just from a quality of life perspective, but one of the advantages that Kentucky has always had in attracting new residents has been our affordability edge. We're generally considered a very affordable state. I want to be clear on something. We still are in comparison to a lot of high-cost jurisdictions around the country. We're not the coast. We're not there yet. That chart would look very different for a lot of our coastal communities. But this is something to watch very closely because without that affordability edge, you're losing your competitive edge when it comes to attracting new folks to the state.
One, just stop short of we're not there, not we're not there yet. Okay, we're not there.
Correct.
I don't know that we will ever be there. I hope we're not. And then Co-Chair McDaniel.
Thank you, Mr. Chairman. And one of the things to add in there, Charles, that in the supply side is the number of units that have been pulled out of the single-family housing stock for short-term rentals. I think I saw the number was something like 400,000 last year. And when you have existing supply pulled out in order to become, in essence, an investment property that is not, a full-time rental for someone, but instead is only rented out for the occasional visitor, that removes from the housing stock as well. So it's not just that it's not being built, it's that the existing stock is being depleted by an entirely new type of business activity as well.
And this is an important part of the conversation, Chairman McDaniel. And our perspective on that is it's a balancing act, right? Because having those types of short-term rentals, that's a helpful thing for our tourism industry. There's a lot of folks that travel these days that might prefer that type of experience over a hotel or vice versa. And so in an ideal setting, we would have a housing market that could accommodate those types of activities to, again, complement changes within our tourism sector. But to your
I don't
point,
necessarily dispute that, for tourism purposes, almost all of us use these things on a regular basis. But from a public policy point of view, you can't neglect the fact that you have a tremendous amount of housing stock pulled offline in order to accommodate that side of things as well. Yeah. Thank you, Mr. Chairman.
Thank you. Following up on that, do you have or have you come across any data that informs on Kentucky's market of housing and how that may have been decreased with Senator McDaniel's point of housing being repurposed for short-term rental as opposed to traditional residential rental?
I do believe there are state-level estimates of short-term rentals, and so that would be unobtainable. Chairman McDaniel, I think I may have heard you cite statistics before to that.
If you don't mind, will you get that? Will you get that to
up.
us, please, and we can get it out to anybody that's interested? Representative Bojanowski.
Yeah, so I was just kind of reflecting. So you're talking a lot about purchasing houses, and my thought would be that the same implication would happen for people who are looking for rental housing. Is that just the same dynamic but applied to rental housing?
Yeah, there's a supply and demand imbalance with our rental market as well. And one of the another chart that I did not include here explores something called the vacancy rate. And I won't get into a whole lot of detail on this, but vacancy rate is the percentage of your total housing supply that is actually available for rent or for to buy. Our vacancy rate in both of those categories has been in a steady state of decline, and so that's happening in the rental market. That's also happening in the single family home ownership market as well.
And please, Senator Boswell.
Thank you, Mr. Chairman. Yes, this whole housing thing has been a major source of frustration for me. About 2 years ago, I was going to build 72 units of housing, affordable housing, approved by my planning and zoning 7-1, defeated by the fiscal court of my county. And I don't remember any help from the Chamber of Commerce or anybody else that came to my aid. And so I would suggest to you that as we see this problem around the state, maybe possibly the Chamber of Commerce could get more involved in when something like this comes up to help builders, because builders get frustrated and they just say, hey, they just throw up their arms. So this is my own personal view of what's happening in the state. It's very difficult to do housing units in the state of Kentucky in some areas of the state.
Very good. Please proceed.
One more quick slide on housing before I turn things over to Kate. We also want to talk about this from an economic development perspective and for the perspective of trying to optimize our currently available workforce, because another challenge that comes from having inadequate housing supply, particularly in areas that are experiencing economic development, is that it results in significant economic inefficiencies and missed opportunities for workers. And so the way to think about this is if you have economic development activity happening over here, you have qualified workers over here, but because of these housing challenges, those workers are not able to connect with those specific areas and take those jobs. That has a ripple effect in a number of different ways. It negatively affects that employer. It also means that there's a job being held right here that could be held by another person over here, and it has that ripple effect. In economic terminology, we use a term called spatial misallocation, which is the inefficient distribution of economic resources. And this is something that's actually been studied in quite a bit of detail. There was a major study that came out in 2019 that looked at some of the worst housing markets in the country, specifically the Bay Area and New York City. And because of the housing challenges within those jurisdictions, they estimated that our economy was nearly $2 trillion smaller at that time than it otherwise would have been. And the big challenge there is that they're creating jobs in some of those jurisdictions, but nobody can move there to take those jobs because there's no housing and it's so expensive. We've wondered, how big of a problem is this at Kentucky? And we don't have a problem on that scale. But we do have some indicators that are a bit concerning. One of the things we did as part of the housing study that we did in 2024 is we did a lot of data analysis, but we also just went and talked to a lot of Kentuckians. And we went to 6 different communities around the state, talked to about 150 community leaders and surveyed them on a range of different questions. But one of the questions we just asked them was, if a major economic investment with 1,000 new jobs was announced in your community tomorrow, do you think your region is currently well positioned to meet a growing demand for housing? And about 90% of them said no. And I'll be honest with you, that 4% that said yes, I think were some overly enthusiastic economic developers. It's generally, a lot of folks do not feel confident that they can accommodate that growth. And when you have that dynamic, you're going to end up with spatial misallocation and a lot of missed opportunities. So some of this comes down to, do we have the capacity to flip that switch when we have economic development and bring that housing online when those things occur? With that, I'll turn things over to Kate.
And I hate to interrupt, Representative McPherson.
Yes, thank you, Chairman. You mentioned Bowling Green. I'm a real estate appraiser for 30 plus years in that area and watch those trends go. You can't have affordable housing if you can't have an affordable lot. I've seen those lot values go anywhere from years ago, $15,000, $20,000 up to $80,000 to $90,000 a lot now, and so it's hard to put an affordable house on an unaffordable lot. I do think you hit on a thing right here. If we're going to have economic development in these areas, I think some of our industrial parks and stuff, and we get to infrastructure, is one of probably the most limiting factor of housing and growth, is to identify areas around these industrial parks that we could tie some of this infrastructure that we're putting to the industrial park and go the next mile, and then make that part of the package of building affordable housing, maybe rental housing, and then affordable housing in front of 2 or 3 stage part of that, to tie on to the investment we're doing for the infrastructure for the industrial park, and just extend that forward and help the cost of infrastructure. That's just a thought process.
Yeah, very good. Very good.
All right. Thank you, Charles. So I'm going to talk a little bit about some of the recommendations that we have ready for the 2026 legislative session. And I want to mention the Kentucky Collaborative on Childcare. This is the group we convened last year. 40 people we brought together of various backgrounds and various opinions about childcare. That was intentional. We wanted to create a little bit of conflict there and to come up with a consensus document on what we could work together on to recommend in terms of improving our childcare system and strengthening the network of childcare providers across the state. And they came up with 37 recommendations. And the good news is I'm not going to hit every single one of those in detail today, but they are laid out in our report, and they're not all targeted at the Kentucky General Assembly. It's not all policy solutions. Some of this is for philanthropy, nonprofits, businesses that want to get involved in these issues. But some of the examples that we're going to be talking about in the upcoming session that I just want to hit on quickly, regulatory relief. This is not about ratios. I know that comes up quite a bit when we talk about child care centers. That's not what the group wanted to work on. They felt the ratios were appropriate, but there are ways to streamline and address some of the regulatory challenges. It's a very burdensome regulatory system, as it should be, in the sense that we're taking care of our children. So you certainly want a system that is robust. But we have found in other states that have studied this issue that they've been able to find ways to make improvements to the system, cut red tape. Maybe there's some compliance reporting that they can make changes on. So we like to do a similar study that we've seen in other states in that regard. Micro centers. So when you think about childcare, you think about childcare centers, which you're familiar with. And then you also think about childcare in homes. And we're looking at something in between, which might be a facility or a center that cares for up to 30 kids. and it might be in an office building or on a college campus where there is some extra space available, and it might serve a specific workforce. And in those cases, you might be able to make changes to the regulatory framework. Maybe the kitchen requirements aren't quite the same because you have a smaller group of children being cared for in a facility. We've seen this in Indiana and Oregon. It's been helpful. We're also looking at our TRISHARE program in Kentucky. This is the Employer Child Care Assistance Partnership. This is what we started back in 2022. You passed legislation back then to start this program. This is the program where employers can provide a child care benefit, and it is matched up to dollar for dollar from the state fund. And we think there's some ways to make some improvements so that it's more accessible to employers and employees. We're hearing it can be kind of tricky to work through it, the application process, renewals. So we can look at a scenario where maybe it's contracted out through a performance-based contract. So that's something that we're focusing on. Our All-Stars program, which is the quality rating system for child care centers, it's been around for a while. It'd be a great time to take a look at that. We've seen success in other states where they have studied this particular system. I remember this from when my kids were in child care. You had the 3, 4, 5-star centers. So just better understanding what you get from those different levels and making sure we're getting the outcomes as we step up a level. So we're recommending some study around that. And then lastly on child care, the One Big Beautiful Bill Act made some changes, some increases to incentives to employers that want to do on-site, near-site child care, or that just want to be involved in increasing the slots for child care. And so we can look at doing an incentive in Kentucky that complements or mirrors something like that at the federal level. We do have employers, members that are engaged in this issue and that want to be helpful in this space. So that could be a policy that is helpful. And then on the housing side, we are very much, as you can tell from Charles' presentation, very much focused on supply side. We know that there is demand for housing, whether we're talking about single family owned or multifamily or rental. We know that there is demand for it. And so our policy recommendations really focus on building more housing and addressing some of the challenges that you face when you're building more housing. There's already quite a bit of discussion going on because of the task force and because of work in the 2025 sessions. You guys are already there and talking about some of these recommendations that we have and that we're going to be putting forth. We think there should be like a menu of options that communities can use. Communities are different across Kentucky, and so there might be different ways that you can support communities in building more housing. Some of the examples that we've worked on in the past was supporting the Housing Development Districts Bill, House Bill 7, in the 2025 session. Also, the Residential Infrastructure Development District Bill, Senate Bill 50, over in the Senate was one that we worked on. We're also supportive of tax incentives to the extent that they can be helpful in building more supply and more housing. And then you've also probably heard us talk a little bit about the Residential Infrastructure Fund that was created in Indiana, which supported 3,000 new housing units in 17 communities. And there could be ways to incorporate some of that into policy in Kentucky as well, dealing with that infrastructure piece that you mentioned with the industrial parks that can be so costly for a new development that can then get passed on to the homeowner and drive up the cost of housing. So those are a few of the recommendations. We know there'll be more discussion around housing. A lot of great work has been done on it in the task force. And so we certainly want to be helpful as new ideas come forward. And then lastly, I put up this screen with our QR codes if you want to grab links to those reports. We've sent all this to you. You've gotten our child care report earlier this year. The housing report you received when we published it. But if you want to grab that too, if you want copies of it. And of course, we're happy to get you anything else that you need. And with that, Chairman, I'll open it up to more questions.
Very good. Thank you both for the presentation. Well-worn topics, but unsolved issues. No silver magic bullets, but it's going to be how do we keep pressing forward to make progress on both of those. Representative Thomas?
Thank you for your presentation, both of y'all. Down in Fort Campbell, they are experimenting with a child care issue. They regulate the daycares already through the federal, since they're a federal institution, and they're asking us to maybe let the federal take over the regulations instead of the state regulating the daycares and the federal. I think it's a test pilot right now, maybe kicking back on some of our regulatory aspects and let the feds take it. So I didn't know if that is something you've looked into, because I think if it's successful, they'll probably pilot, they'll try to expand it to Fort Knox. And that helps a lot of the military wives, be able to get employment too.
No, I think that's certainly something that we need to go explore more. The United States military, this actually is an area that they've been very proactive in. So childcare facilities on military bases are something that have been available for a long time. And so I think using those and leveraging those for broader community impacts, that's a sensible way to do it. So that's certainly something we'll look into and explore more. Thank you for bringing it up.
Very good. Representative Truitt.
Thank you all for your presentation. We'll talk a little bit about the child care. And you talked about all the different people that have kind of worked on some solutions. Obviously, you all know my area of expertise, and I see lots of parents daily who want to go to work, but they can't because maybe there's not a daycare, or a lot of 4-year-old parents would like to send their kids to school, but they don't qualify for. So I wonder what your all's, opinion is on, or your thoughts are on right now. Few students qualify for preschool education. What's your thoughts on, would that be an option at some point if there were more students allowed to be in a preschool setting, or maybe working with our schools to where, like my school this year opened up a daycare for employees, which is a great thing. And I think that came from some of the stuff that you all been working on. I'm just wondering, seems like, we've got the rooms, we've got the employees, we've got the people working, we've got people wanting to become teachers. It just seems like a perfect mix, maybe, but maybe I'm in the wrong lane. I'm just asking what your all thoughts are.
No, I think that's a great question. And, one of the things I didn't mention that I think I should is that we're very interested in a community-driven approach and supporting communities with this notion of childcare ready communities, based on some of the work that we've done on recovery ready communities, Representative Bowling in the past, and looking at how communities can identify their specific childcare challenges and how different programming can work. We've had discussions around like a cooperative model where the school, the employer, maybe there's a hospital in the area, and maybe the local government can come together and potentially through a micro center fill their need. We have heard that there are schools that have looked into that particular issue. We did have K-12 as well as higher ed folks represented on our collaborative. So I think you're going to see more of that community-driven discussion around it. And perhaps, and you're talking about 4-year-olds and Head Start programs, I presume is what you're talking about. There might be some good discussion around that as well.
Very, very good. And Representative Truitt, I'm going through this issue with several different groups. It's hard matching up a school schedule with a regular work schedule is one of the biggest difficulties we run into. So no snow days, no rain days, no flu days, no summer break days. It's hard matching up those schedules. I'm not saying there are plenty of hybrid solutions that can be utilized and leverage what we have at the schools. I wish that they were explored more. And I would caution one thing, daycare offered for school employees, it sounds enticing, but there's one thing I'd like to point out is the more benefits are extended to teachers or even non-certified employees at a school system that's not compensatable pay, then that means we're diverting money away from the retirement systems. And the more those daycares and those benefits extend, the more diversion away from the retirement systems. We've run into that issue previously in a very large degree with higher education. I don't want the same thing to happen to K through 12.
Well, they're paying for it. The employees are paying for this. It's just offering them an option to keep their kid there at school, and also open for students who who have kids of their own. So
I
it's
think that's good, and I've run into several that do not do that. There is no pay; it's a straight benefit, and it runs into a really quick issue. Senator Nunn.
Thank you, Mr. Chairman. As I sat and thought about your explanation to my question, I think you may have hit the nail on the head. Could I ask the chamber for some kind of a analysis of states that expanded in that time frame, 2013, 2014, versus those that didn't, to see if they had a similar drop in the states that expanded versus those that didn't? I think it would be instructive not just on Medicaid, but maybe policy in general.
Yes, sir. We can look into that.
Thank you very much.
Thank you.
Back into us, we can get it distributed to anyone interested. Anyone else seeking comment or question, be wary of the clock. Everybody's going to start looking at you very harshly. But anybody else have a comment or question they want to be recognized for? Thank y'all very much for the presentation, and back to the CPAs. Thank y'all very much. Also, I'm not giving short shrift to, but correspondence received under 5. Please review. Please ask questions if you have it. Reports received, the same. Staff's always willing to talk about that, and I am also. And please note the next meeting of the IJC on A&R will be October 15 at 1 p.m. back in the same room on the same channel. We're adjourned. Thank you. Oh. About. And I tell you what, I am going to let Senator Boswell make a point.
I've been talking for quite some time about property owned by the state that's excess. In Owensboro, Kentucky right now, we had a piece of property I've been saying need to be sold. I'm happy to report it got sold to a private industry for $3.3 million. This is just one example of the property we have in the state that's vacant and needs to be sold. But the most important thing I want to know about this, it says it was sold to the state. I want to make sure that money makes its way back to the general fund. So if somebody out there can give me the answer to that, $3.3 million.
Very good. Thank you, and we remain adjourned. What you got?